Welcome back. So in the last video, we talked about how a housing bubble might form, or really sort of any asset bubble, where increases in prices lead to people expecting prices to keep going up, so they buy, and the bubble inflates until there's really nobody left who is willing to buy at those prices, and the prices start to go down, and now the positive feedback mechanism works in reverse, and the prices crash. Now, in this video, what we're going to talk about is sort of why this was a problem macroeconomically, right? So I mentioned in the first video, I think for chapter 8, that we had an asset bubble in internet stocks in sort of the late 90s that popped in 2000, caused a minor recession, but not a significant one. But mostly the big difference here is that the stock market bubble in the 90s was not caused by debt. People were not borrowing money to buy those stocks. And so when the prices collapsed, they lost some money on paper, but it didn't affect the financial sector. And whereas with the housing bubble, when that crashed, it did sort of spread throughout the financial sector because the banks and what sort of became known as shadow banks were holding these assets on their balance sheet, and they fell in value, and they became technically bankrupt. Really, the only major one that went bankrupt was Lehman Brothers, but a number of the others were bought by other banks. All right. So we talked about leverage, right, in chapter 6. And leverage is this idea where you can increase your profits or your return on equity by borrowing money. And it works great as long as prices go up and your investments are successful. But of course, as soon as prices start to go down, it increases the risk of bankruptcy. So this is really sort of important to understand in the housing market, both on the sort of household side, right, where borrowing a lot of money as a mortgage to buy the house can increase your profits when the price goes up, but also on the financial sector side, where they want to sort of decrease the amount of capital they have, right, increase their liabilities as much as possible, in order to increase their return on equity. And so we'll start with an example on the household side, where basically, if the price of a house is, say $400,000, the more you borrow in a mortgage, and the less down payment you have to put, then the more upside there is when the price goes up. Right. And so this was really what was going on in the 2000s, is that people were buying houses with very big mortgages with the expectation that they would then sell those houses when the price was up, maybe in 6 months or a year, and make a lot of money. Right. But when the price goes down, now that small down payment disappears, and now the house is actually worth less than the mortgage. And so then what do you do? So let's just do some examples with some numbers. So let's imagine a house costs $200,000, and the buyer makes a down payment of 10%, which is $20,000. So if you are making a 10% down payment, that means you have to borrow 90%, which is $180,000. That means that the buyer has equity in the home of $20,000, right, equal to its down payment. And the leverage in this case, if we just do debt divided by value, right, so that's 180 divided by 200 is 90%. Now, if the price of the house goes up, so let's imagine it goes up by 20%. So 20% of $200,000 is $40,000. So it's up to $240,000. The return on equity is really high, right? You've just put down $20,000 and you made $40,000. That's a return on equity of 200%. 40 divided by 20. And the leverage now will actually have fallen, right? Because now it's 180 divided by 240. And so as long as you're sure that prices are going to keep going up, then, that's what you want to do, right? You want to borrow as much as possible, buy maybe as many houses as possible, and you'll make a lot of money. Now, usually it's difficult to borrow a lot of money in this type of scheme, especially for a household, right? But the difference in the housing market is that it's a collateralized debt, meaning that there's an asset backing up the mortgage, right? So it's secured by the house. And so if you don't pay your mortgage payments, the bank can take possession of the house. Now, that means that the bank has a responsibility for making sure that that house is worth what the buyer is paying for it, because if it's not, then if the bank repossesses the house, then they are going to lose money on that transaction. And I think part of the problems in the 2000s were that a lot of the steps that were put in place in order to make sure that the house was actually worth that much, that the borrower would actually be able to pay back the mortgage, that they had, documented income and credit, sort of fell apart, right, in the rush for, profits, both on the household side and on the bank side. So one way to think about, sort of the macroeconomic implications of increased asset prices, and especially increased housing prices, is called the financial accelerator. And the idea with the financial accelerator is that if the housing prices keep going up, then that increases the value of the collateral, right? It increases the equity that homeowners have, and that allows them to borrow more. That allows them to spend more, and GDP can keep going up, and housing prices will keep going up. But of course, that works on the way down as well. So as soon as the housing prices decline, that means that homeowners have less collateral. That means they can't borrow as much. That means that they're not going to buy as many houses. And again, it will decline. And so whether we're talking about sort of GDP in general or housing prices specifically, we end up with either, the positive feedback loop where things are going up, or the positive feedback loop where things are going down. All right. Now, the other thing to think about is this idea of target wealth. And we'll come back to this a little bit in chapter 17 when we talk about the Great Depression. Obviously, households want to save because, they either want to save just for like a rainy day fund, or because they're saving for retirement. And so they have some target wealth. And when their major asset, their house, increases in value, then their wealth is above their target wealth. And so they're more willing to spend, right? And so okay, well, my wealth is so high, I can maybe buy a boat. I can buy another truck. I can go on a vacation. And so that's what's going on when we, have that increase in prices. When prices start to fall, maybe my target wealth is my wealth is below my target wealth. And so now I'm not going to buy that truck. I'm not going to go on that vacation. And so this is, sort of a fall in autonomous consumption, right? If we think about our aggregate demand model, our Keynesian cross, that C0, that's a decrease in our consumption, sort of independent of income because it's related to wealth. So if we think about sort of wealth and debt, obviously the poorest 20% have very different balance sheets than the richest 20%. For the poorest 20%, they might have a lot of debt and so much less net worth, right? So the blue here is home equity, and the green is financial assets, and the red is debt. Whereas the richest 20%, even if their debt is actually higher, which we saw in a previous chapter, as a percentage of their assets, it's much smaller because they have so many more assets, right? And so specifically, they have a lot more financial assets. And so home equity is much more important for not just the poorest 20%, but the next 20% and the middle 20%, and even that sort of fourth 20%. It's really not until we get to the top 20%, the top 10%, the top 1%, that housing equity or home equity is less important. So if we look at sort of growth and income over sort of the last 70 years, what we see is that after the Second World War, sort of these groups were all growing fairly steadily, right? So here we've set 1971 equal to 100, but you can see the top 10%, but also the middle 40%, the bottom 50% were all growing pretty well. And then after 1970, the bottom 50% has basically been treading water, right? They're really not any better off now than they were in 1971. Now, this data ends around 2016. I will say that there has been, since the pandemic, some growth in income for that bottom 50%. So that's a good thing. The sort of 50 to 90% has experienced some growth, and certainly not nothing, right? It's sort of 35 to 40% higher than it was in 1971. But the top 10% has experienced a lot of growth. And that's was sort of the pattern that we saw, at least until the pandemic. Since the pandemic, we've seen more sort of growth in the lower groups, but it's still fairly modest. If we look at wealth, we can see that wealth basically for the bottom 50% and even that middle 40%, that 50 to 90%, tracked housing values pretty closely. And so when housing values fell, the bottom 50% really lost a lot of their wealth. That again has recovered somewhat, but again, it's really because of housing prices increasing. And so, whether or not those stay high, it's such a vexed issue because you don't want people's wealth to collapse, but at the same time, you want the next generation to be able to buy, houses as well. You can see the 10% saw the top 10% saw a modest decrease in their wealth when the housing bubble popped, but that increased again fairly quickly. The other thing so we talked about leverage for households, but leverage in banks also increased. And you can see it was a fairly steady increase for U.S. investment banks. One of the things we mentioned in an early video is that these U.S. investment banks, which had traditionally been partnerships, switched to being public companies owned by shareholders. And so that may be one reason that they're willing to take on more risk. The UK banks were a little bit late to the party, but increased their leverage fairly substantially as well. And then, of course, both saw decreases in their leverage after the housing bubble popped, partly due to increased regulation. So the big problem for the sort of macroeconomic regulators and the financial regulators in the financial crisis was that we had all these really big banks and a bunch of them were failing, right? Bear Stearns, Merrill Lynch. And so the Fed especially managed to find buyers for Merrill Lynch and Bear Stearns. But then when Lehman Brothers was failing, there was no one left to buy them and they went bankrupt. And the concern was that now if Lehman fails, then there's a bunch of what's called contagion, right? Like it spreads throughout the financial sector because Lehman Brothers had a bunch of assets that were, linked to other banks. And so, some of their assets were other banks' liabilities. Some of their liabilities were other banks' assets. And Lehman Brothers wasn't going to be able to pay back a lot of those liabilities. And especially in the interbank market, right, the reserve market, banks sort of stopped lending to each other because they were worried that the other bank would be going out of business and wouldn't be able to pay them back. And so this was a problem, right? So banks traditionally had kept, they keep just the minimum amount of reserves. And so they rely on that interbank market to borrow and lend reserves. But now when, their liquidity was so sort of compressed because of the uh, freezing up of the market, that meant that even banks that were healthy, where their assets were worth more than their liabilities, had the potential to go out of business. And so, what are you going to do if you have to pay back liabilities, but you don't have the liquidity? You have to start selling your assets. And if you're selling your assets for, trying to sell them quickly, then you might not get their full price, right? We call that a fire sale. Now, I think it's debatable. So if we talk about the financial crisis, whether or not the fire sale was the main problem or the fact that a lot of these assets were mortgage-backed securities. And a mortgage-backed security derives its value from mortgages, and the mortgages were all worth less because the housing was worth less. And so we had this big sort of problem sitting on the balance sheets of all of these financial institutions. And it was, bad in the United States. It was bad in Spain, but it was sort of threatening to take down the global financial system. And so that would have been worse, right? If the global financial system had collapsed, we would have ended up probably in another Great Depression. And so, the Federal Reserve and other central banks, but sort of led by the Federal Reserve, basically bailed out all of these financial institutions. One, by lending money to anybody who needed it so that they wouldn't have to sell assets. And two, by buying a lot of those assets themselves. So buying up those mortgage-backed securities that nobody else would buy. Now, the interesting thing is that this was successful. Both macroeconomically, even though we had a bad recession, it was not as bad as the Great Depression, which we'll talk about in chapter 17. But also financially, because it was able to stabilize the market. And so the Federal Reserve actually ended up making money on these mortgage-backed securities, which is they were probably the only institution that would have been able to do that. So I think one of the main criticisms of the banking sector from this time period was that they had taken on too much risk, right? And I mean, it's kind of, I don't know if ironic is the right word, but we had experienced a financial crisis in the Great Depression. We had spent the 30s sort of putting on regulations onto the banking sector. That had sort of made banking boring, less profitable, but we didn't have any financial crises. And then we started getting rid of those regulations in the 80s and the 90s and into the 2000s. And banks started making riskier investments, taking on more debt, building these mortgage-backed securities, collateralized debt obligations, synthetic CDOs, and that black swan event happened, and the entire system fell down, and then the banks were bailed out. And so obviously, if you're a bank and you feel like, well, when things are going well, I make huge profits, I get big bonuses, I can buy that house in the Hamptons. And then when things get bad, then the government bails me out. Well, that's not a great model for the rest of the economy, right? And so after the financial crisis, we did increase regulation to some extent. We increased capital requirements. So remember, capital is just assets minus liabilities. Capital requirements in the banking sector are a little bit more complicated than just doing assets minus liabilities. There's sort of levels of capital. But we increased capital requirements in order to, increase that sort of size of the cushion that banks could, had in case of a similar financial crisis. And we also said, all right, well, we need to be able to allow banks to fail. And so we need to have a way for systematically important banks to fail. And basically, they're required to say, okay, well, what would happen if I went, if this bank went bankrupt. Um, so, has that been successful? In some ways, I think it has been. I think it has reduced risk to some extent in the financial sector. Um, as I said, right, housing prices are even higher now than they were in 2006. But at the same time, we don't see as much risky lending in the market. Um, and so it does seem like housing prices might be driven more by, just very high demand, in which case the solution for, reducing housing costs is really to increase supply. All right. So we'll stop there. In the last video for Chapter 8, we'll look at sort of other markets where we can apply this model of a price dynamics curve and tipping points. One kind of negative when we look at climate change, and one potentially positive when we look at the adoption of new technology.